Tesla drops its Q1 2026 earnings. The numbers roll in and they look good. Positive cash flow, beating estimates. But the very next morning, the stock opens down 4%. This chart shows the specific figures Wall Street usually loves. Earnings per share hit 41 cents, beating expectations of 36 to 39 cents. And they delivered a surprising $1.44 billion in positive free cash flow, silencing fears of a cash burn. Yet investors hit the sell button. They're looking past the headline profit and focusing on a structural decay that the top-line numbers can't hide. This waterfall chart breaks down that profit. When you strip away the one-time boosts, warranty reserve releases, tariff refunds, and favorable currency moves, the underlying margin looks dangerously thin. The core automotive business is stalling out. Revenue missed the $22.6 to $23 billion estimates, and vehicle production outpaced sales, creating a growing pile of unsold cars. And the energy storage division, which was supposed to be their next growth engine, took a hit. Revenue dropped 12% year over year, and deployments fell 38% from the previous quarter. Tesla's traditional revenue engines are sputtering. This creates a gaping hole in their growth strategy that threatens the entire valuation of the company. Elon Musk used the earnings call to deliver a warning. He is dropping financial caution entirely and nearly tripling capital expenditures to over $20 to $25 billion for 2026. Musk is diverting that cash away from car factories to fund the Texas Terafab, a global supply of chips and sprawling AI infrastructure. The target for all this computing power is Optimus. Musk claims the humanoid robot will enter production by summer and eventually scale to 10 million units a year. For investors, this $25 billion spend is expected to push free cash flow completely negative for the rest of 2026. He is sacrificing short-term automotive profits to force a total reconstruction of the company into an AI and robotics giant. This scale shows forward price to earnings, or PE. It's a metric that tells you how much investors are willing to pay today for a company's future growth. Traditional automakers usually trade at a multiple of 6 to 10 times their earnings. Tesla is currently trading at a multiple close to 200 times its future earnings. A 200 multiple cannot survive on the slowing sales of a traditional car business. It requires the exponential, high-margin tech sector growth that only autonomy and robotics can provide. The $25 billion spend acts as a survival mechanism, justifying a valuation that the car business cannot support on its own. Wall Street is completely split on this strategy, creating a deadlock of buy, hold, and sell ratings. This tug-of-war shows the bull case. Canaccord Genuity targets $450, citing FSD doubling and Optimus's potential. But Wells Fargo maintains an underweight rating, citing years of cash burn and over 20 lawsuits representing $14.5 billion in legal exposure. The average price target settles right around $400 as a hold. Even the professional analysts are unsure if this high-stakes bet will pay off. For everyday investors, you have to watch 3 metrics. First, monitor unsold vehicle inventory. Second, track the Optimus timeline. If production slips past summer, the narrative takes a hit. And third, watch how deep that negative cash flow actually goes. Standard quarterly delivery metrics are secondary now. The thesis has moved entirely to the performance of the neural network. You have a choice to make. You are either buying a 200 times multiple on the future of global AI automation, or you need to exit before you are left holding an overpriced automaker.